Welcome back to Markets at Noon. Taking a look at the markets, we are seeing a mild recovery from the day's lowest points, but definitely Nifty as well as Bank Nifty, they continue to trade in the red, as well as the breadth of the market is definitely not looking that supportive. But with this, what to make out of the market right now, and how should you place yourself amidst this volatile market? Let's try to find an answer to that. And we are being joined by Jigar Mistry, who is the co-founder at Point Capital. Hi Jigar, good to be speaking with you. The screen across is definitely red, and we can debate about the factors that are in play for the Indian benchmark indices, maybe it's valuations, maybe it's slower earnings, but give us a sense that how much more pain is left in this sort of a market, Jigar, because though definitely the portfolios are red, but don't you believe that the sentiment now is also turning very pessimistic? So what's been your reading across the board?
Yes, good afternoon. Thank you as always for inviting me on your show. I think it's that pendulum effect, right? The farther we took it from the equilibrium, it stands to reason that, it will push back on the other side so that the equilibrium is, eventually achieved. If you look at the earnings growth and the share price movement of the small cap index at its peak, we saw that the earnings was growing at the same sort of 16-17% CAGR over the past 3 years. But at its peak, the share prices were moving at a velocity of 25% CAGR per year, creating that 10 to 12% of alpha or excess build out for 3 years in a row. The reason why we think that was happening is because sort of the unprecedented wealth that was generated post-COVID, especially by the retail investors. If I put some numbers to it, at the bottom of the market in COVID, March 2020, the total of retail ownership, and I'm excluding mutual funds and life insurance, was around 16 lakh crores. By September 24, that number had ballooned to a whopping 67 lakh crores. There is some amount of flow into it, but a large part of it was mark-to-market gains. And just to put in perspective of how large a 50 lakh crore number is, whatever India saves in real estate, gold, silver, equity market, debt mutual fund, and bank deposit, at the net level last year was 14 lakh crores. So there are like 25 crore savers who are saving, 14 lakh crores. And there were 2 to 3 crore active demat account holders who generated 50 lakh crores in wealth, predominantly from the small and micro cap stocks. And many of them started believing that this is the only way to generate wealth on a sustainable basis. So money kept flowing into this illiquid small cap stocks, which resulted in the EPS and share price dislocating to a level that it had to fall under its own weight. A large part of that, I think, is resolved. So I was working up the numbers this morning, and today the overall sort of number is only at a 10% cumulative. Share price is higher than your earnings growth. So unless earnings goes down materially, I think we have seen some part of the pain left. But as I said, if you have taken the pendulum to one extreme, then it's not fair to assume that it will stop when the equilibrium is reached. It may go on in the other side, which will then create opportunities for the next rally.
Okay, Jigar, this is Nehi also joining in. Thanks for those views coming in. Help us understand what your portfolio construct is looking like right now. How have you positioned, made any changes, exited or entered into a sector, changed your stance, maybe gone overweight to underweight or the other way, given the kind of market correction that we're seeing right now? What I can understand from your portfolio right now is you're very big on BFSI. That's something you like. And FMCG is somewhere that you've, slowed down your allocation a little bit. Wouldn't that be surprising now that growth is coming back to FMCG? Help us understand what your portfolio construct is like at the moment.
Right. Hi, good afternoon to you too as well. We think that there were two pivotal items in this budget which we haven't seen in the previous almost 10 budgets. One, there was a conspicuous move away from capex into consumption. The central government did it to the tune of 1 lakh crores, but if you analyze the state budgets of the last 12 states that went into election before Delhi, we found that their capex bill was somewhere around 4.3 trillion INR. whereas their social spending / freebie budgets were 3.1 trillion INR. So, given the increasing move of the states towards a lot of these freebies and the center also joining in, there was, as I said, the state, center, and PSU capex were growing at around 30% per annum for the past 3 or 4 years. And I think there is this conspicuous shift which we now need to take into account. The second thing is that, if you take the budget numbers for this time around and adjust for the fact that capital gain tax is not linear, right? They've assumed that capital gain tax, which is a very large number, by my estimate, 2.5 lakh crores of the total 12.5 lakh crores tax collection at the center level. Of that number, if you assume that, capital gain tax would halve, then underlying personal income tax is expected to grow at something like 35% as per budget documents, which we don't think will likely get delivered. And most of this will result if you can't really collect enough tax and you miss it by say 1.5 or 2 lakh crores, then that number has to either come from lower capital expenditure at the center level or higher disinvestment, because I think they're maxed out on RBI dividends. And in that scenario, obviously for capex or the stocks which were going on a big narrative, right? Capex, your railway, a lot of other solar, renewables, all those stocks, need to correct even more from here for it to sort of make sense. On the other hand, consumption is a large basket, and whatever money comes in, the velocity, the entry velocity will not be as high. But those businesses were not discounting a lot, and very clearly that is the reason why we had changed stance into consumption. And banking is a sector that we have been overweight for almost a very long period of time. And the reason was that, we think investors are focusing on the fact that NIMs are slowing and deposits are hard to come by, or the asset quality at the margin is deteriorating. But a lot of people are not paying attention to the fact that what you're paying to buy these businesses is not overtly expensive. And, yes, the earnings is slowing down, maybe to say 15% from 25%. But the stocks are discounting on a reverse DCF something like 7-8% earnings growth. And therefore, as a sector, BFSI put together was almost 40% of our exposure by January. And the third, in terms of market cap allocations, in March 23 last year, or around May 23, sorry, our exposure to small and mid caps was almost 63%, if memory serves. Today, small cap exposure for us is close to 25%. So we had, over the past 6 or 7 months, started moving very aggressively into larger cap businesses. And today, larger caps plus cash account for majority of our portfolio.
All right, that's good to note, Jigar, how you have made those transitions and moving away from these myths. But Jigar, talk to us about the insurance space, because what we see is that you have 10% of the allocation within this basket. And just in the near term, if I see some of the triggers, then the industry growth is not that exciting. There are some risks in terms of the functioning of these businesses with respect to threats on bank assurance. Give us a sense that in the long run, how do you see the insurance story playing up? And as an investor, do you believe that it's still a good time to go ahead and add more of insurance plays?
We do, in fact, because you are right that the open architecture threatens some businesses more than others. So even within the broader challenges that present itself either via the sort of open architecture, banca versus direct, etc., one needs to take into account the fact that you may have to get positioned in a business that is relatively less impacted on account of this. There was some confusion in the budget, but I think that was duly noted and taken cognizance of. At the end, I think that the penetration of insurance in India can only potentially move up. And that is the reason why, we have increased the weights as the markets kept on correcting these stocks, and we are reasonably positive on most of them.
Okay, Jigar, thanks so much for joining us. On that note, we'll let you go. Once again, thank you for sharing your views and your portfolio construct as well. But on that note, viewers, time to slip into a very short break on this edition of Markets at Noon. Just quickly marking the recovery we've seen. We're close to 22,100. So it's been a stellar recovery that we've seen in the last couple of minutes, and 90-point uptick from the day's lowest point. We'll be right back on the other side of this short break.